Everybody thinks they know the story of Lehman Brothers. At its height, it was the fourth largest firm of its kind in America and managed hundreds of billions of dollars in assets across the world. But less than a year after recording its best ever year, it was gone. In the early morning hours of Monday, September 15th, 2008, the firm's chief legal counsel sent an email officially declaring bankruptcy in the Southern District of New York. It was, and still is, the largest bankruptcy in history, and it marked the climax of the global financial crisis. In the hours that followed, the markets had their worst day since the 9/11 attacks in 2001, and the panic spread across the entire global economy, taking the world from an economic downturn into a full-blown crisis. Now, you already knew this, but something that's normally missing from these oversimplified headlines is what actually happened in the months between Lehman Brothers recording record profits and failing so spectacularly.
Lehman's is another classic case of city boys trying to make too much too fast.
Optimism at Lehman Brothers one day after the investment bank filed the biggest bankruptcy in U.S. history. And news Barclays is buying the bulk of the company.
A pivotal moment in the financial crisis. Letting Lehman's go under caused panic on the markets. Suddenly, no bank was safe.
Hold long before the dramatic collapse of Lehman Brothers last week.
To highlight just how much is misunderstood about the rise and fall of Lehman Brothers, here's a question for you. What was Lehman Brothers? If you are brave enough, leave your answer in the comments below. It wasn't a bank, it wasn't a hedge fund, and it wasn't a stockbroker, and it wasn't a private equity firm. For the sake of simplicity, most industry insiders just called it an investment bank, because of its history, even though by the time of its collapse that was just one tiny, almost inconsequential part of the entire business. The firm was started in 1847 by the Lehman Brothers. Far from its eventual place amongst the elite firms of Wall Street, Henry Lehman actually opened a dry goods store in rural Alabama. 3 years into running the shop, his brother Emmanuel joined him, and the business name changed to H. Lehman and Bro. Yes, they little broed him. 3 years after that, the pair's third brother, Mayer, also joined the business, so they gave up on the constant renames and decided to just call it Lehman Brothers. But spoiler alert, this would not be the last time the firm changed its name. Even these humble beginnings of selling convenience goods to cotton plantations revealed something that would be a common trend throughout the company's entire history. They were not tied down to a single business model. They would happily move into any industry where there was money to be made. For example, the brothers quickly realized that they could make more sales with cotton plantation owners if they just accepted raw cotton in exchange for their merchandise instead of currency. They of course had to resell this cotton on the open market, but they could normally do that at a significant markup over what they got from the farmers. Eventually, they realized that trading cotton was far more profitable than running their shop, so they closed it down and became full-time commodities dealers. By 1858, just 8 years into their operations, the center of the cotton trade had moved to the up-and-coming port city of New York, since that was where most transatlantic shipping originated. By this time, Henry, the original Lehman brother, had passed away from yellow fever, so the two remaining operated separate offices, one in New York and the other back in Alabama. Unfortunately for this new trading business, just 3 years later, New York and Alabama had something of a disagreement. But not even the American Civil War could keep the Lehman Brothers down for long. The conflict and the eventual abolition of slavery radically reshaped the market for cotton, and they were there and ready to profit off it in a big way by helping to form the New York Cotton Exchange. Basically the NYSE only for cotton. As old school as this sounds, the Cotton Exchange actually still operates in New York City to this day. Lehman Brothers also branched out into trading other commodities like coffee, tea, and orange juice, and got a taste of the finance game by extending loans to help rebuild their home state of Alabama after the war. So at this point, Lehman Brothers had been a convenience store, a cotton khajiit, a market maker, and an alternative lender, but it wasn't until 50 years after its creation that it finally became an investment bank. You see, the big boss man over at How Money Works wants to make it really clear that investment banking actually means something specific, and it's not just a catch-all term for finance bros. Now, what that is admittedly a little bit confusing. Investment banks are not banks, and by definition, they don't invest in anything either. You need to instead replace the word bank with middleman. A blood bank is a middleman between blood donors and patients who need it. A food bank is a middleman between food depositors and people in need of a meal. And a bank is really just a money bank, being the middleman between depositors and borrowers. So an investment bank is an investment middleman connecting people who want to make investments with businesses that need to raise money. By 1899, Lehman Brothers was making a small fortune being the middleman between commodities producers and consumers, so they figured the next best step was middlemaning entire companies. That same year, they underwrote the initial public offering of the International Steam Pump Company. Underwriting basically meant that Lehman Brothers looked at the company, deemed that it was fit for investment, and guaranteed that if enough shares didn't sell on the public market, they would personally buy them. If things went badly, this liability could have been enough to wipe out half a century's worth of business operations. Fortunately for the brothers, this IPO was a huge success, with all of the offered shares selling out within the day. In the process, it made Lehman Brothers more money in fees than they would make in an entire year of trading. A small side note is that the International Steam Pump Company would also go on to make the elevators in the Eiffel Tower, and its founder, Benjamin Guggenheim, was a member of the family that commissioned the world-famous art museums that still operate across the world today. Tragically, he would never see these public marvels because in 1912 he was amongst those who died at sea when the Titanic sank on her maiden voyage. Over the next 20 years, the Lehman Brothers and their firm slowly transitioned away from trading commodities and more towards trading companies. They underwrote several of the biggest IPOs of the time, including Sears, Macy's, Goodrich, and Studebaker, often partnering with another up-and-coming firm by the name of Goldman Sachs. By teaming up to underwrite company offerings, they could spread the risk and share in the reward, while always making sure they had a consistent stream of business. That was until 1929, when the market crash and subsequent Great Depression slashed stock market activity. For a business that now almost exclusively relied on listing other businesses on the stock market, this could have been yet another death blow. But the firm, ever adaptable, decided that it would take this time to get into a new business: venture capital. Venture capital is a type of finance where wealthy investors will take a stake in very new businesses to give them the money they need to get their idea off the ground. In the 1930s, this was almost unheard of. Businesses were started by people who had the means to fund early operations themselves, and only after years of operation would normal investors consider coming in. But Lehman Brothers saw potential, especially during the Great Depression. There were hundreds of thousands of talented people out of work who had good ideas, but no money to make them a reality. Business lending had all but stopped after several banks had collapsed, so Lehman Brothers had a golden opportunity. By being the first investors in a business, they could get a huge stake for very little upfront investment. If the business was a success, it could make returns hundreds of times greater than the original investment. It was very risky, of course, but by finding talented entrepreneurs with no other opportunities, they could be confident knowing that their winning bets would cover dozens of losers and then some. In the process, they also increased social mobility by offering opportunities to people who otherwise would have struggled to get them, even if that was just a happy little side effect. Today, venture capital is a mainstay of modern business, but back then this really was a revolutionary concept, and it kept them making money even while Wall Street went into hibernation. Alright, so far, Lehman Brothers has been a corner store, a cotton trader, a commodities dealer, a market maker, an investment bank, and a venture capital firm. But it didn't stop there. After the Second World War, the firm eventually started doing, well, a little bit of everything. It had divisions for all of these financial services, and it basically treated them each like competing companies. Bonuses would be showered on the divisions that made the most money, and entire floors were routinely fired if they didn't perform. This was a great way to motivate some people, but it ultimately made for a pretty toxic work environment. Teams didn't want to cooperate with one another, and in many cases would actively try to sabotage the other so they could stay on the good side of management. In the 1970s, this earned the company a nickname, the Devil's Casino, a nod to the excessive risk-taking and backstabbing that happened within the company's glistening skyscraper. There were enough stories to fill a book, and they did. It's a very interesting read, so like always, we will leave a link to it below. In an interview 20 years later, the company's M&A chairman said that Lehman Brothers had an extremely competitive internal environment, which ultimately became dysfunctional. That salty executive just so happened to be Stephen Schwarzman, who would leave the company soon after to start Blackstone, the largest private asset manager in the world today. This fragmented company was good at making money for the people who worked for it. But with so much disarray between departments, nobody even knew what the company really did apart from make money by moving money around. The problem was that a lot of teams figured they could make more for themselves by going out and starting their own firms rather than operating under this confusing mess of an organization. In a way, it had become the BuzzFeed of finance, slowly bleeding talent and profitable operations until 1984, when it was acquired by American Express. For the next 10 years, the Devil's Casino was reduced to a name alongside Shearson and Hutton, forming Shearson, Lehman, Hutton and American Express Company. A bit of a mouthful, and not a particularly effective operation. The strange abomination of a company basically did two things: work as a retail brokerage and get into scandals. Whether it was check fraud or financing the Boston Mafia, the Shearson and Hutton part of the business had some difficulties, to put it nicely. Eventually, this became too much for American Express to bother dealing with, so in 1984 it spun off the companies and Lehman Brothers was once again free to set its own destiny under the stewardship of a maverick new CEO. Over the next 14 years, it would be home to the greatest rise and fall in American financial history. So it's time to learn how history works, to unravel how Lehman Brothers' century and a half of business adaptability collapsed within 9 months. Today's episode is sponsored by Brilliant. Brilliant is the ultimate platform for anyone who wants to not just learn, but truly grasp complex concepts. With thousands of interactive lessons spanning maths, science, and technology, it makes learning both engaging and effective. I'm especially excited about their new How AI Works course. It dives into the inner workings of language models, showing how they learn and generate text. Whether you're just curious about AI or considering a career in tech, this course offers a hands-on way to explore one of today's most powerful technologies. I've been going through the course myself, and it's incredible to see how different models function and how they can be fine-tuned for various tasks. Whether it's writing poetry or drafting professional emails, Brilliant makes complex topics like this approachable, even if you're completely new to them. And the best part? You can learn on your own schedule, seamlessly fitting Brilliant's interactive lessons into your daily routine, whether you have just 5 minutes or a full hour to dive in. To explore everything Brilliant has to offer, including their new How AI Works course, for free for 30 days, head over to brilliant.org/howhistoryworks or click the link in the description. You'll also get 20% off an annual premium subscription. The final chapter of Lehman Brothers' long and diverse story was defined by a single man, Dick Fuld. Now, apart from having the worst name in financial history, he was an incredibly interesting gentleman. He temporarily pursued a career in the Air Force but never made it to service. Fuld allegedly got into a fist fight with another cadet and was expelled from officer training. After that, he got his first job at Lehman Brothers at the age of 23 and just, never left. He was there for the company's glory days as the Devil's Casino, and by his own recollection, he really enjoyed the fast pace and competitive atmosphere. On the other hand, he hated the period in which the company was split up, merged and mixed in with American Express. During this period, he diligently worked his way up the corporate ladder, trading fixed income securities, but always felt like he had missed out on Lehman Brothers' best years. He also openly considered the executives who had left the firm at that time to start their own operations traitors. And this would be really important once he was handed the reins. By the time American Express offloaded Lehman Brothers, Fold was the obvious choice for CEO. He had been with the firm for a long time, he had well and truly bought into the company's vision, and he was running one of the few profitable departments the firm had left. After gaining control, Fold wanted to bring back the company's glory days, and set out on a mission of rapid expansion. The firm borrowed aggressively and rebuilt multiple departments from the ground up. When they couldn't start something from scratch, they would buy out other firms and bring them in-house. By the 2000s, they once again had a department that operated like a hedge fund, an investment banking division, a private equity office, an asset management arm, and a growing department with providing mortgage origination and packaging services. Lehman Brothers had seen how profitable mortgage-backed securities were as a financial product, and took the idea to a new level. They purchased Aurora Loan Services and BNC Mortgage so they could make their own loans before packaging them up and selling them to institutional investors who wanted the supposedly predictable returns. Every time they did this, they would earn a healthy fee, and quickly this small department became a nice little moneymaker for Lehman Brothers, which was looking to diversify in any way it could. By all accounts, Dick Fold was actually quite a competent CEO. Outside of overseeing such a massive and rapid comeback, he also expanded operations internationally, opening offices in Europe and Asia to offer a growing list of services to a growing list of clients. It wasn't like he was blessed with an easy tenure either. He guided the company through the Asian financial crisis in 1997, the dot-com crash, and the attacks on 9/11. Lehman not only felt the shock of the market crash after these events, but the company's global headquarters, at the time, was in Three World Financial Center. This was not one of the directly targeted buildings, but it was still damaged by falling debris beyond the point of being habitable. So the entire company was temporarily set up in 40 different locations, including the Sheraton Manhattan Hotel. Lehman Brothers booked every room to convert into office space for its growing investment banking team until they could find a new permanent global headquarters. Now, even during the good times, this rapid re-expansion didn't come without some growing pains. The thing with having so many departments under one single firm is that it's hard to tell who should and should not be working together. When the investment banking division of a company like Lehman takes on a company as a client, they need to see a lot of detailed financial information that isn't yet publicly available. That kind of information would be really useful to the trading division, which could buy or sell a company's stock based on this privileged information to gain an edge in the market. This is, of course, insider trading, which is illegal, but it's much harder to track when it happens within a single firm. Lehman Brothers was eventually fined for this behavior, alongside most of the other big banks on Wall Street. And it led to a new rule where the investment banking division of these firms had to be kept completely separate from all other operations. At this point, you might have noticed that the Lehman Brothers of the early 2000s was starting to sound a lot like the Devil's Casino era of the late 1970s, and so, naturally, the company could have developed the same problems. Fold had learned from these mistakes though. He demanded loyalty from all of his executives, threatening to destroy their financial careers if they dared to leave the firm without his blessing. But he went even further than that. Most bonuses were not paid in cash, but rather shares in the company that could only be sold after a lock-up period. If an employee left before they could sell their stocks, they would forfeit that bonus. But if the firm was doing well, they would get a new bundle of locked-up stocks every year, indefinitely, keeping them on the treadmill. Restricted stock bonuses are common today in finance and tech roles, but they really got their start on Wall Street in the early 2000s. Now, to play devil's advocate for a second here, Dick Fold, either out of devotion or delusion, held himself to the same kind of standards of complete loyalty to the firm. He was reportedly paid more than $500 million during his tenure as CEO, and most of that came in the form of stock bonuses. But instead of selling these shares as soon as he could to free up cash, he kept most of his wealth tied up within Lehman Brothers itself. According to second-hand reports from people close to him around this time, he would often also buy more shares in Lehman, often on margin. As a financial professional, he surely knew that having his employer also be the majority of his personal wealth was an incredibly ill-advised position to be in. But he did it anyway, either to show his subordinates how much he believed in the company, or because he genuinely did. It's up to you to decide which one is scarier. The other big change he made was just making Lehman a good place to work. Beyond the life-changing money that could be made at the firm, by most accounts, people seemed to generally enjoy working there. It was still competitive and high stress, but strong performers were given their dues and people who made mistakes were not immediately punished, as was the culture elsewhere on Wall Street. In 2007, the company announced that it had had its best year ever. It had made a profit of over $4.2 billion on revenues of more than $19 billion, and now managed a pool of assets worth $640 billion. This all came from a company that just 13 years earlier was sold off by American Express because it simply wasn't worth dealing with. Unfortunately, while most of the executives were celebrating, the company's fate had ultimately been sealed. There was one other problem with diversifying the company so broadly so quickly. Every new department in the firm carried with it risks which could sink the entire ship. Dick Fold's aggressive expansion ambitions meant that all of these operations were consistently pressured to take on more risk to help the company maximize returns and grow faster. Of course, one of those departments was subprime mortgage bonds. It's a common misunderstanding that the firm had gone all in on these products by the time of its collapse. In reality, subprime mortgages only accounted for 3% of the firm's total revenue in 2007. However, even that relatively small operation was operating in such a volatile way that it carried more than enough risk to blow up the entire firm. You see, Lehman Brothers may have had over $600 billion in assets at this time, but that number by itself doesn't mean anything unless you consider the debt. The actual equity in the company was only around $22 billion. On a good day. Everything else was made up of debt. And here's the thing. Asset prices can rise and fall, but debt stays constant until it's paid off. Borrowing so aggressively had let the firm grow and maximize returns during the good times, but even a small hiccup could have put the entire global enterprise into negative equity territory extremely quickly. A more relatable, real-world example would be someone putting a 3% down payment on an investment property. If property prices increase by 10%, they have more than quadrupled their money. But if prices fall by just 3%, they have lost all of their money, and they still owe interest. This is exactly the position that Lehman Brothers was in. And that small mortgage bond department was like a hand grenade amongst the clockwork. The actual profit that Lehman Brothers made by giving out loans to regular people and then packaging them up to sell to institutions actually wasn't very big. So to generate good enough returns to keep Dick Fold happy, the department borrowed a lot of money so they could handle more loans at any given time. This was seen as relatively low risk for two reasons. The first was that the bank wouldn't actually own these mortgages for very long. Between the time they made a loan and the time that it was packaged up with thousands of other loans and sold off to something like a pension fund was typically around 1 month, if they were doing their job right. The second reason they didn't see a problem with taking on so much debt to get the money to give out mortgages was because they were mortgages. In the absolute worst case scenario, it was assumed that they could get their money back by foreclosing on people's homes and selling those houses to, in turn, repay their lenders.
But the key factor here is these are essentially just mortgages, so that has allowed us to push the leverage considerably beyond what you might be willing or allowed to do in any other circumstance, thereby pushing the risk profile without raising any red flags.
But by mid-2008, it was becoming clear that both of these assumptions were just wrong. The hot real estate market was starting to falter because even with easy lending to anybody who wanted it, there was only so much that people could afford. Another common misconception about the collapse of Lehman Brothers is that this is where the global financial crisis started. In reality, the economy was already in a technical recession for a full 12 months before this. The Fed had raised interest rates again after dropping them to 1% after 9/11.
In fact, interest rates were below inflation for almost 3 years, below the rate of inflation. Now, how do you think about this? So when you're looking at a house, can I afford this house? Can I afford the payment? Obviously, those payment streams are determined by the level of interest rates. And when interest rates are low, you're going to buy a bigger house. You're going to buy in a better neighborhood. You're going to buy cherry cabinets and granite countertops because you can afford it.
After rates went up again, this debt just simply caught up with people. This slowed home sales and lowered house prices, which meant that there were no longer any guarantees that selling a home would completely cover its mortgage. The other problem was that big investors were starting to lose their appetite for mortgage-backed securities, so Lehman Brothers was forced to hold on to them for longer and longer, basically getting high on their own supply. It was also revealed that in an attempt to make money, Lehman was keeping a lot of the riskiest and therefore highest yielding bonds for itself because when everything was going well, they were paying as much as 12% interest, where the firm could borrow money for as little as 4%. Lehman Brothers, under Dick Fuld, was a rocket ship. But rocket ships are just controlled explosions that are always right on the edge of catastrophic failure. By September, the firm had an inventory of bad loans that it couldn't sell. And without being able to sell them, it couldn't meet its debt repayments the next day. Operationally, it was still exactly the same firm it was 9 months earlier, but now instead of producing record profits, it was functionally insolvent. On Friday the 12th of September, leaders from all of the major banks on Wall Street were called to the Fed headquarters in New York City, just a few blocks away from Lehman's new head office. Dick Fuld was not invited. They were there to discuss what to do with the firm which couldn't afford to open its doors on Monday morning. A few months earlier, Bear Stearns had been bailed out in a joint agreement with the government and JP Chase. Like Lehman, Bear was an institution that got caught in the trap of trying to do everything and ran into trouble when the bad parts of their business sank everything else. JP Morgan and its new CEO Jamie Dimon saw the opportunity to buy up the good parts that still made money and let the government deal with the toxic debt bomb that was left over. Naturally, at a time when people were already starting to lose their homes, this made people furious. So when Lehman found itself in the same position 5 months later, the political support wasn't there anymore, especially since there was now an election just a few weeks away, and nobody was winning any votes by supporting Wall Street.
The news from Wall Street has shaken the American people's faith in our economy. The situation with Lehman Brothers and other financial institutions.
We have to explain that this affects Main Street, not just Wall Street.
To this day, financiers, bankers, economists, and, worst of all, politicians, argue if it would have been better to bail Lehman out to prevent a wider panic. But did we learn any lesson from it? Well, not really. We are now more in debt than we ever have been before. We kept interest rates too low for too long, and financial firms are figuring out new and creative ways to lend money to people who have no business paying it back. Before Lehman became American history, it was shaped by it. It lasted so long because it adapted to the times and maybe learned that doing one thing well is better than trying to do everything. Go and watch this video next to learn how the same mistakes caused every economic crisis for the last 2,000 years. And don't forget to subscribe to keep on learning how history works.